How is everyone doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to look at a very interesting article from the Wall Street Journal that examines Fair Isaac, in particular, the fact that they just increased prices and that their competitive advantage could be in a little bit of danger because of some regulatory changes. Now, if everybody remembers, I had put up another episode earlier this year where I talked about changes that the Fair Housing, I believe it was the Fair Housing Association, wanted to make to residential mortgages and the type of credit scores that were used to do those. Basically, they wanted to use a different type of a Fair Isaac credit score model. And then they also wanted to bring in what was called the Vantage score model. And that basically therein lies the issue of Fair Isaac, they have a great product and their revenues are really good. But, what happens if basically, the regulators cause some of the underwriting or some of the things to change where basically different products get used and now that maybe hurts their revenue. So this article in particular was called Invest in Banking Like Warren Buffett, Own a Castle. And it basically, and it goes on at the beginning to basically say how, Warren Buffett likes to invest in companies that have kind of like are like, theoretically have a moat around them. And so they start focusing in on companies that are focused in on basically data and analytics, but companies that have a very diversified product line, companies like Moody's and S&P Global, where it says in here that basically, they both these companies have long been diversified well beyond into many different businesses and products that supply or analyze financial data. These businesses provide banks, investors, insurers, and others with the tools for highly specialized and highly regulated tasks. And he goes on to talk, he talks about Equifax, Experian, TransUnion, financial information services stocks tend to trade at higher valuations than the lenders or investment managers that they rely on. Generally, they can benefit from having proprietary data or ways of analyzing data and supplying benchmarks that everyone must use. They can enjoy high margin on recurring revenues, such as software subscriptions. In other words, a profitable moat. One standout, however, in this realm right now is Fair Isaac Corp, often known by its ticker symbol and flagship product, the FICO score. Fair Isaac doesn't supply credit data itself, but by employing data from credit bureaus or its clients, it produces scoring and analysis that its clients use to make underwriting and other decisions about customers. Fair Isaac shares have been among the top performers in the S&P 500 over the decade, returning in excess of 40% annualized, according to FactSet data. And it has a company among just S&P financial sector stocks as of Wednesday's close. MSCI and S&P Global and Moody's all have bested the top returning bank over 10 years, JP Morgan Chase. And here's a great chart here basically showing the revenue at Fair Isaac scores segment by quarter. And you can see here from it goes 2019 all the way up to the fourth quarter here of 2024. And we can see how we're heading up towards, 250 million and now that's revenue per quarter. So that's 250 million, which means they're approaching $1 billion in revenue. But just this year, Fair Isaac shares have more than doubled. This is in part because the company has demonstrated what theory suggests should be possible for a company selling an industry standard benchmark, like its credit scoring, changing its pricing. So Fair Isaac recently said it was raising the wholesale price of a FICO score from mortgage originations from $350 to $495. A couple of years ago, it made the switch from volume-based pricing to fixed pricing. So FICO cited higher unit prices when it reported a nearly 40% year-to-year revenue gain in sales of credit score services to lenders and other commercial users in its most recent quarter. Mortgage origination revenue was up 95% at what is hardly a buoyant time for the mortgage business. Yes, I mean, mortgage business is not that great right now. But that kind of growth and strength doesn't come cheap. Fair Isaac now trades at a forward price to earnings ratio above 75 times, according to FactSet data. On average, the 8 information services companies mentioned above trade at an average PE ratio of around 35 times. That compares with under 15 times for S&P 500 banks. That raises the question, of whether the moats around these information providers are really deep and terrifying enough to help these companies keep up with high growth or high profit expectations implied by those stock price multiples. Fair Isaac hasn't only been changing its pricing, it also has been expanding the range of applications of its core platform, aiming to help not just lenders, but retailers and others make decisions about how to serve a customer. That has helped propel growth in its software business. There are some challenges on the horizon. For one, there is the volume question. Information companies can also be exposed to cyclical ups and downs in activity, such as if high rates discourage mortgage borrowing. Then there is competition. For years, mortgages guaranteed by Fannie Mae or Freddie Mac have needed a FICO score, but the regulator that oversees those entities plans revisions to the requirements, an updated version of the FICO score, and the introduction of another score from Vantage Score. When the upshot of this isn't clear. The presidential election will likely result in change of leadership at that regulator, and there is a swirl of other variables such as future pricing or what share of the mortgage market is going through Fannie and Freddie. FICO scores are widely used in the mortgage market outside of those enterprises as well. So this could be a reason for some investors to be cautious regarding Fair Isaac at today's share price. The current valuation hasn't really factored in many downside risks related to potential regulatory changes, said anonymous research analyst Kelly Zhu. Still, investors might be thinking about the potential for an upward swing in demand for information related to lending, as well as deal making and corporate finance. That could power a strong year across information and analysis merchants in finance. Castles do change their flags from time to time, but there will always be a need for a moat. Yeah, so I think it's a very interesting article, and it points out some of these data servicers, like Moody's and S&P Global. They all have kind of diverse product lines for the most part. They have kind of proprietary software services that they provide, such as what Fair Isaac does. I just think that Fair Isaac is a very interesting case because, again, your three major credit bureaus, they all use this. But things are changing. I mean, we have seen a number of changes to the credit bureaus and to the FICO score, model that they use for creating credit reports. Like, in other words, tax liens, certain types of medical debt have been removed. There's questions like, do we add buy now, pay later to the credit scoring model calculation? So there's definitely going to be variables in flux. I think there's also a lot of people that would like to look at what's considered like alternative data, monthly rental payments, utility payments, paying like, your Verizon bill and Comcast bill and things like that to basically show a stable payment history that this person, they do pay their bills on time every month. They do make the regular payments. They are a good credit risk, as it were, in the banking business. So, and again, it goes back to that old theory, though, as they increase their price and they've gone to this, not a volume model, but a fixed pricing model, this drives up the cost for, banks. So every time a bank, goes to do a mortgage with somebody, they have to pull a credit report as part of their underwriting practice. And that goes for anything, whether they're buying an auto loan, whether they're getting a mortgage, whether they're getting a credit card, whether they're getting a business loan. No matter what it is, you're pulling a credit report on that individual, depending on what that loan request is, and then you're including that in the underwriting. And so this is basically just, driving up the cost. And then again, some of these costs can be passed on to consumers. Some of them cannot. Again, depending on the loan product, like if you're getting a home equity loan, the bank probably is going to eat the cost of that credit report. They might charge you something for loan documents or something like that, or maybe a standard fee, $250, $500, and a large chunk of that might actually go to cover the appraisal if they have to do either a full appraisal or a drive-by or something like that. But it gets back to cost. And in other words, and then will banks or will other companies look for other type of products like Advantage Score or maybe, I don't know, to a company like LexisNexis or something like that basically will offer them maybe different type of metrics to judge the customer, but basically do in a roundabout way the same thing that the FICO score does, but maybe does it at a cheaper price point. like I said, it's just interesting to look at because there's just a lot of different variables here going on. As far as is anything happening to them tomorrow? No. Is their stock price maybe a little high right now? Perhaps. Yeah, perhaps looking at some of those technical and fundamental analysis, you might come to the conclusion that, hey, they might be a little overbought at the moment. But that's not stock advice. I don't do the stock advice here. I'm not. I don't. Don't tell. Full disclaimer: I don't give stock advice. I don't give financial advice. I'm not telling people what to do with your money per se. I'm just talking about the larger issue of Fair Isaac and their business practices and how that may affect what goes on with consumers and banks, as it were. So, but anyway, like I said, I thought this was interesting. I think we're going to have to keep an eye on this and see how this kind of changes or unfolds in the months and years to come. And we'll see what happens. Obviously, what the regulators decide to do with a lot of this is really going to have a major determination. But anyway, I will leave it at that. And I will basically say, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Please be sure to leave your comments down below, as I always like getting back to everybody. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please make sure to check out the BND Strategy Room live stream, which will be tomorrow night, Saturday night at 8 p.m. Eastern Standard Time. As I do I cover a lot of great information in those live streams. So if you haven't checked one out, please make sure to do it. And I will be back with everybody again next week with more episodes. Until then, have a great weekend, and I'll see everyone again soon. Thanks.